All right, the Federal Reserve said today the pace of economic contraction is slowing. It predicted inflation will remain, quote, subdued for some time. For more on what the Fed said, we have an expert panel. Dino, Koss is managing director at Portales Partners and a former New York Fed official. Bloomberg editor-at-large Tom Keene is here, as is Bloomberg economics expert Kathleen Hayes. And live from his offices, Ed McKelvey, senior U.S. economist at Goldman Sachs. Ed, why don't I start with you, since you're remote there, and ask you what your take was on today. No change, but it is kind of dramatic to see that the Fed's sort of playing the waiting game here.
I think the essential message is that they don't see as much downside risk as they did before. And I see that in two places at least. One, their statement about inflation, while it does say it would be subdued for some time, also says that omits a statement that they made back in April saying that they thought that there might be an unacceptably low rate of inflation. And secondly, they didn't take the bait on changing some of the language of the commitment and the program parameters to strengthen their commitment to lower rates. It's still pretty strong, but they didn't make any changes there.
They do have a commitment to lower rates, Dino, and a lot of people have been saying they need to come out and make a forceful statement here. Were you satisfied?
Well, let me just make, they didn't take another piece of bait, which is that some people were arguing that they should lay out an exit strategy, which would have gone in the other direction. They didn't take that bait either. So they were trying to navigate down a middle road where they were saying, we're going to support the economy, we will have accommodative policy for a while longer, and we don't have one foot out the door, which was one of the things that some people thought that they might decide to do. So they didn't do that.
Nouriel Roubini, actually. Do we have the Nouriel Roubini side? Let's listen into what he said earlier on the show. Apparently we don't, but he was saying just that. He thinks we need to lay out an exit strategy and is really concerned about growing deficits, obviously. Should the Fed come out and make this kind of statement? Is it something that maybe Larry Summers should talk about?
Well, deficits are an issue, right? You've got a $1.8 trillion deficit for fiscal 09, more deficits in the years that follow, and the market is worried, will the Fed be monetizing some of these deficits at some point? Now, at some point, the Fed, will have to be a little bit more direct in addressing that issue. Bernanke has made a statement, we will not monetize the debt in testimony recently, but the committee might have to come out more forcefully at some point and address that issue.
Tom, what are you hearing about this? I know you were speaking this morning with David Malpass, and you're talking about with people about this all day.
I was speaking with Nouriel Roubini earlier this morning. I know Kathleen knows you drop into our world headquarters every day, and we each have our own different days. I had a much more international day today in talking with Professor Roubini and with Brad DeLong at Berkeley. And I think the message I got today that this is a central bank that can't work in a vacuum. There's all this discussion, and Ed and Dino can talk about it, and Kathleen, but on a game theoretic basis, they've got to work within the global community, and you saw that with the Swiss intervention this morning. I mean, they're all bouncing off each other as they try to come out of this crisis and also adapt to a real economic contraction.
John Goodfriend was saying the exact same thing last week on this Wednesday roundtable. They need to work in concert, and they're not doing a good enough job.
Well, what I took away from talking to Bill Poole, former Federal Reserve Bank president in St. Louis, Bloomberg contributor, and Lyle Gramley, a former Fed governor, is that any sense of recession ending, economy bottoming, they say is still a forecast. And so the Fed is not in a position where it can afford to signal anything but sort of steady as she goes. Now, what I'd kind of like to put out to Ed, to bring in that Wall Street view of the bond market, Ed, if the Fed starts signaling an exit strategy, is that potentially good for the bond market because it says we know we have to start withdrawing liquidity? Does that help bring bond yields down? Or is that the kind of thing that scares the bond market and would cause yields to back up again?
I think you can make both arguments, frankly, because obviously if the signaling of an exit strategy means that higher short-term rates are closer than you otherwise thought, then the bond market does have to figure that. But of course, it also does mean that the inflation rate or that the Fed's taking a more anti-inflationary stance. If I could make one further point on the monetization issue, or maybe a couple just real quickly. First of all, this is a statement about monetary policy, and monetization's kind of at that intersection of fiscal and monetary, might be more appropriate for his testimony as Chairman Bernanke already made before the Budget Committee. And they did sort of take a position in a way by not increasing the Treasury purchase program, which is still bringing the Treasury levels to below where they were before all the rundown in their system open market account started.
Are you concerned, though, Ed, that we don't get mortgage rates back down again? Because we've seen them bounce up, and obviously the Fed has made lower mortgage rates one part of its recovery strategy. Well,
yes, I think they're probably bothered. They would like to see those rates lower, but they have also said that higher rates are symptomatic of an economy that's reverting back to somewhat more normal conditions, and we're far from normal, believe me, but we are progressing in that direction, perhaps more than they thought in April, and I think they're willing to tolerate that.
Isn't, Dino, isn't the housing problem one of the big differences between this recession and the last recessions that we've witnessed?
Well, I mean, in the last recession, housing just continued to boom. There really was almost no slowdown in the 01 recession. So you have two things now. You have both the housing collapse and the equity market collapse. So you've had two things that are affecting the wealth of consumers, and that did not happen in the last recession. We had an offset, right? You had equity markets going down, housing markets rising, and the consumer just did not feel what he's feeling in this cycle. That's what's going to make this a somewhat longer, more protracted recovery.
But Dino, what do you pick up when I'm sure you still have some contact with your old Fed colleagues and just more broadly on Wall Street about the political pressures on the Fed, the fact that the Fed may have to withdraw liquidity, start raising interest rates against an unemployment rate that is still rising, heading north of 10%. Is the Fed up to it?
Well, this is a big question, right? There's two questions about the so-called exit strategy. One is technical capability. Do they have the technical tools to do it? And the second one is, do they have the political will to do it? On the first one, I don't think there's any doubt that they do have the technical capability. There's all kinds of reasons to believe that that's not a barrier. But the other issue is a real one, which is that that the Congress will say, wait, don't tighten prematurely. Certainly, the White House will be in the same position. So it's going to take some spine on behalf of the Fed to actually mobilize itself and do what needs to be done if they are to head off inflation. Now, I think, having said that, we're some time away. We're not going to have an inflation problem for certainly for a while, several quarters, if not years. And this is something that the Fed will have to confront, but not immediately.
All right, we're going to take a quick break here. Dino Koss is going to stick with us, as well as Tom and Kathleen. Ed McKelvey staying with us as well, live via satellite from his office, only a few blocks away. Email me any questions or comments if you like. mtmiller@bloomberg.net. We're right back in 2 minutes with more on what the Fed said and how it affects you, the viewer, the investor, the homeowner, the employed or otherwise. Stay with us. All right, we are back now for more on what the Fed said with Dino Koss, Managing Director at Portales Partners, and our own Kathleen Hayes and Tom Keene, as well as Ed McKelvey, Senior U.S. Economist at Goldman Sachs. Dino, let me ask, because you mentioned it, and actually a viewer wrote into me this morning and said, hey, it's not about housing, it's about the labor market. You may agree with him or disagree with him, but what do you think about the Fed's other role?
I'm sorry, which?
The Fed's other role in keeping a close to full labor market.
The other side of the mandate.
You've got the dual mandate, and you have a 9.4% unemployment rate. That's going to head higher. There's really not much that the Fed can do about it in the short run. And what they can say is, well, look, we've taken rates down to zero at the short end. We have all these programs in place to try to stimulate and support the economy. So I think that they're on pretty solid ground there. Ed, I'd be interested in your thoughts on that.
Yeah, I don't think they could do anything about it in the short run. The one thing we've noticed pretty systematically is they do not tighten before the unemployment rate has peaked. And while you could argue that maybe they would start to earlier because of the low level of rates, I suspect that most committee members would be quite reluctant to take that vote until they've got enough sense of durability in the recovery that they are, in fact, seeing a peak in the unemployment rate.
Ed, what do you think about when they do tighten? Because, we did a survey of all the primary dealers. All 16 said definitely not this year, although Jeremy Siegel was on with Kathleen and myself earlier, and he said he thinks by the end of the year.
I don't think there's much chance of that at all. In fact, we don't have it in this year or next. But the longer you go out on that kind of view, the more it becomes dependent on your own economic view. And we certainly are not looking for anything like a V-shaped recovery. We think the unemployment rate will rise throughout 2010.
Tom, what are you hearing about V-shaped, U-shaped recovery, W-shaped recovery?
Well, I don't use the alphabet soup. I don't know that many letters, but as Dr. McKelvey talks about there, the Goldman Sachs calls 10.5% by end of the year. Nora Robini told me today 11%. The political economics of Fed policy in Washington really must change when you see that kind of unemployment. And then you think of the underemployment. I mean, Matt, can you imagine a 20% underemployment rate? That statistic that is so important with the part-time workers that don't want to be part-time, the discouraged workers. I think it's a game changer as you go through 2010, and that's how you get that Goldman Sachs view that extends out. And others, and keep in mind, there's others that disagree with that. I think of Larry Cantor at Barclays Capital with a much more optimistic assessment. But that's the debate right now among economists. I mean, Kathleen lives with that every single day. Not only the dispersion in dollar calls, the dispersion in unemployment calls, and how it then folds into Fed policy.
Well, J.P. Morgan Chase, Bruce Kasman's the chief economist over there, and they have a more optimistic view of more growth in the second half. That obviously more optimistic than Ed's. The Fed, though. I think what's really telling is Ben Bernanke has said, and others, Richard Fisher, president of Dallas Fed, who I interviewed recently, pointing out that we don't want to make the mistake that the Fed made in the 30s, and we don't want to make the mistake Japan made. It's a worse mistake, I think they're saying, to withdraw the stimulus too quickly than to leave some stimulus in the system and get a little inflation. And there are people who would even say, we need some inflation now, right?
Well, who is it? Greg Mankiw has this great line. He says there are things worse than inflation. We have them now.
Yeah.
And you hear Alan Blender has said the same thing. He made that argument in an editorial that he wrote that said, listen, if you tighten too soon, or if you take away the stimulus too early, you're going to see a repeat of what we saw in 1938.
Maybe that's part of the surprise, because we are starting to turn the corner, some would say, and we've got the stimulus kicking in from President Obama pretty soon. Maybe you get a little more growth.
Speaking of starting to turn the corner, a lot of people, Kathleen, as you know, disagree with you on that. A lot of people think we are not starting to turn the corner. Every time you or I mention green shoots on air, we get a slew of angry emails. I want to take a quick break here, and if you could stay with us, Dino, and if you could stay with us, I'd appreciate it. Just to get your quick thoughts on, have we turned the corner here? Can you use the phrase green shoots? We'll be right back in 2 minutes with more on Bloomberg Television. All right, welcome back to our roundtable on the Fed. We have Dino Koss here, Managing Director at Portales Partners. Also, Ed McKelvey, Senior U.S. Economist at Goldman Sachs. And we're joined as well by Kathleen Hayes and Tom Keene. And I just wanted to get your takes on green shoots and the idea of, have we turned the corner yet? Are we at least beginning to see something that's even beyond stabilization? Every time we say it on the show, we get a slew of angry emailers writing in. Ed, let me get your take first. Have we turned the corner here? Can you even describe things that you would call green shoots if you were a gardener?
Well, the answer to the green shoots question is yes, we can see things that have commonly been called green shoots: consumption, orders, factory surveys, and that sort of thing. I don't think they prove that we've turned the corner. I think they are consistent with the idea that we'll turn the corner in the next quarter or two, by which we mean GDP, but not the unemployment rate.
Dino, what do you think?
I think that's exactly right. There are signs of stabilization in a number of indicators, and probably you begin to get a slow recovery, but nothing to write home about. And that's important for valuations of all kinds of securities.
You know, people get angry about the green shoots comments, mostly, I suspect, because of the labor picture. It looks bad and obviously getting worse. Yeah. And then, if you've lost your job in this recession, you can't take any more equity out of your home because you don't have any more, and you can't sell your home because it's worth less than you owe. Isn't that really what makes this recession so much worse?
Well, I mean, let's remember that in the early 1990s, we had a recession that ended sometime in mid-1991, but we had the so-called jobless recovery. It took 2 years before the unemployment situation really began to shift. So if you get the same pattern here, you know, we might be out of the recovery, as that says in GDP terms, but you might get a weak labor market for many, many quarters afterwards. And so it'll feel sluggish, it'll feel weak for a very long time.
And that's especially true if people are trying to raise their saving rates If you've got an overhang of unoccupied housing, and if business firms are going to do what they did these last two recoveries and just be a little bit more cautious about those signs of demand and not convert them into jobs and income.
And I think that's a really important point, is what's going on with savings, is that the consumer in the last recovery did not save, but added to debt, and consumption just kept barreling along. In this cycle, that's just not happening. Savings are going up, consumption is moderating down.
What about, I want to ask both of you, maybe start quickly with Ed. This looks more like a V-shaped recession going in. It looks more like an old-fashioned recession where you get some V out. Jobs cut so severely, inventory slashed so dramatically. Isn't there some chance that at least for a few months we get something that looks kind of like a V on the way out?
You certainly could have a swing in the inventory numbers that would give you maybe a good quarter here or there. That's certainly possible, but you don't have the housing recovery that's been typical of V-shaped recoveries. You don't have the likelihood of a debt-driven consumer spending surge, and you don't have the employment, at least as we judge it.
Dino?
I think that's correct. I mean, if you think of autos, we've gone from 16 million autos annually down to 9. So yeah, we're going to go back up to whatever 12, 13, some number. I don't know what. I don't have a forecast, but that's up from the bottom, but still quite a bit down from where we had been. So it's going to feel slow.
Tom, let me ask you what you're hearing as far as the recovery plan here and the exit strategy. I mean, a lot of people writing in and saying, look, you just can't borrow your way out of this problem. It's kind of like trying to drink your way out of a hangover, which doesn't work in the long run.
I wouldn't understand what that is. Thank you for bringing that up, Matt. Nice of you to bring that up. I would suggest that the economists are on a different dialogue than the strategists and the pundits that are out there. It's, first of all, this wild card of the savings rate. No one really knows. There's an immense ambiguity about the glide path of the savings rate and also its final destination, what that means culturally and socially. And the other thing, just percolating up on my shows, is this idea of a bimodal recession. Ed hinted at it a little bit here. If you have a lethargy in the recovery, well, do you get maybe a bit of positive GDP? And then what are the risks there of some form of reversion from shock to early 1980s equivalency? That's just percolating up in the last month.
Dino, you're talking about a slow recovery here. We've heard a lot of people talk about the fact that there's going to be a new growth picture going forward. 2% is the new 3%, and we can't really add jobs unless we get to 2% or higher. Isn't that the case?
Well, I'll let Ed speak to what number leads to more jobs, but I think that the notion that we will have to think of what economists call the potential growth rate being lower than it had been, I think that's correct. I think potential growth has come down, and the question really is, we're going to probably grow below that potential for a while, and the question is how long, because that will ultimately determine the peak in the unemployment rate.
All right, so Ed, 30 seconds left. When do we feel normal again? When do we get back to normal, the old black? But
normal being at or above trend growth? Oh, I think it's a couple of years.
Well, what about 5%, 4.5% unemployment?
That's quite a long distance away. That's even more than a couple of years. I would guess somewhere in the middle of next decade.
All right, that's a depressing segment to end on, a comment to end on, but unfortunately that's all we have time for. Ed, thank you so much for joining us. Ed McKelvey there from Goldman Sachs. Dino, appreciate you joining us, as well from Portales Partners. Tom, it's always a pleasure to spend time with you. And Kathleen, I never get to spend enough time with you.
We keep trying, though.
But we try our hardest. Thanks very much for joining us.